There is a debt market so large that it is now worth around $3 trillion. It finances companies you have never heard of. It pays high returns to pension funds, insurance companies, wealthy investors, and, increasingly, ordinary people. It operates mostly outside the banking system, and almost nobody really knows what is inside it. This is private credit, and depending on who you ask, it is either one of the most important financial innovations of the last decade or the next big hidden risk in the global economy. To understand private credit, imagine a company that needs money. Not Apple, not Microsoft, not some giant corporation that can sell bonds to investors around the world. Imagine a boring, mid-sized company. Maybe it makes industrial parts. Maybe it owns dental clinics. Maybe it sells software to hospitals. Maybe it is controlled by a private equity firm that bought it with borrowed money and now needs more debt to grow, refinance, or simply survive. 20 years ago, this company would probably go to a bank. The bank would review its books, negotiate terms, lend the money, and keep the loan on its balance sheet. But after the 2008 financial crisis, banks became more regulated. They were pushed to hold more capital, take fewer risks, and be more careful with lending. That made the banking system safer, but it did not make the demand for debt disappear. Companies still wanted money. Private equity firms still wanted leverage. Investors still wanted yield. So the debt moved. It moved from banks to asset managers, from regulated balance sheets to private funds, from public markets to private agreements. That is the machine we now call private credit. At its simplest, private credit means loans made by non-bank lenders. Instead of a bank lending money to a company, a private credit fund does it. The money in that fund may come from pension funds, insurance companies, sovereign wealth funds, endowments, family offices, or wealthy individuals. In recent years, even retail investors have started to get access through special funds and business development companies. The fund manager raises money from investors, lends it to companies, collects interest, takes fees, and distributes returns. On paper, it sounds clean. The borrower gets money faster than through a bank, the lender gets a higher interest rate, the investor gets income that looks stable. Everybody wins. And that is exactly why private credit has exploded. At the start of 2025, Morgan Stanley estimated the private credit market at about $3 trillion, up from roughly $2 trillion in 2020. Some forecasts expect it to keep growing toward $5 trillion by the end of the decade. This is not a tiny corner of finance anymore. It is becoming part of the plumbing of the economy. But here is where things get interesting. Private credit does not look dangerous when everything is going well. In fact, it looks almost boring. The loans are usually negotiated privately. They are often floating rate, which means when interest rates rise, lenders can earn more. Many loans are senior secured, meaning the lender has a claim on assets if the borrower fails. And because the loans are not traded every second on an exchange, their prices do not jump around like stocks or bonds. That creates a strange psychological effect. Public markets look volatile because you see the price changing every day. Private markets look stable because you do not. But less visible does not always mean less risky. It may simply mean the risk is harder to observe. Think about a house. If your neighbor sells a similar house for less money, the value of your house has probably changed. But if you refuse to check the market, your house does not feel cheaper. Private credit works in a similar way. Many private loans are valued using models, manager estimates, appraisals, and internal assumptions. There is not always a live market price. So losses can appear slowly. Stress can stay hidden, and investors may not fully understand the condition of the loans until something breaks. This is why private credit makes regulators nervous. Not because every loan is bad, not because every fund is reckless, but because the system is opaque. Banks, private equity firms, insurance companies, pension funds, asset managers, and retail investment products are now tied together through private credit in ways that are difficult to map. And when nobody can fully see the connections, nobody can fully know where the risk is. To see why this matters, follow the money. A private equity firm buys a company. It uses debt to make the deal work. A private credit fund provides that debt. The fund gets money from pension plans and insurers. A bank may provide leverage to the fund. Another financial institution may buy part of the exposure. A retail investor may own shares in a business development company connected to the same lending ecosystem. The original loan is private. The company is private. The fund valuation is private. The investor base may be spread across institutions and individuals. So when the company struggles, the pain does not stay in one simple place. It can move through the system quietly. This does not mean private credit is the new subprime mortgage market. That comparison is popular, but it is too easy. Private credit is not one single product. It includes direct lending, asset-based finance, real estate debt, infrastructure debt, specialty finance, and many other forms of private lending. Some of it is conservative, some of it is risky. Some lenders are disciplined, some are chasing fees. Some borrowers are healthy companies that simply want speed and flexibility. Others are highly leveraged businesses that cannot easily borrow anywhere else. The problem is not that private credit exists. The problem is that it grew very quickly during a period when investors were desperate for yield. When interest rates were near zero, pension funds and institutions needed returns. Traditional bonds did not pay enough. So private credit looked attractive. It promised higher income, lower volatility, and access to deals outside public markets. But higher yield always comes from somewhere. Sometimes it comes from complexity. Sometimes it comes from illiquidity. Sometimes it comes from lending to weaker borrowers. And sometimes it comes from all three at once. One of the most important words in private credit is liquidity. Investors often like private credit because it feels stable. But the loans themselves are not easy to sell quickly. If a fund owns private loans to mid-sized companies, it cannot always dump those loans tomorrow at a clean price. That is not a problem if investors are locked up for years. A pension fund can wait. An insurance company can wait. A long-term institutional investor can accept illiquidity in exchange for higher returns. But the industry has been trying to bring private credit to a wider investor base through semi-liquid funds. These products may allow investors to withdraw some money periodically. But there is a mismatch. The assets are illiquid. The investor wants liquidity. That mismatch is manageable when only a few people want out. It becomes dangerous when many people want out at the same time. That is why some private credit products use redemption limits. They may allow withdrawals only up to a certain percentage of assets in a quarter. This protects the fund from fire sales. But it also creates a simple reality. If too many investors want their money back, not everyone gets out at once. The door is open, but only partly. Another key warning sign is payment in kind interest, often called PIK. Normally, when a company borrows money, it pays interest in cash. But with PIK, the borrower can pay interest by adding more debt instead of sending cash. In other words, the company says, "I cannot pay you now, so I will owe you more later." PIK is not automatically a disaster. It can be planned from the beginning of a loan. It can help a company manage cash during a temporary period. But when PIK usage rises because borrowers cannot afford cash interest, it becomes a stress signal. It means the lender may still be recording income, but the cash is not actually coming in. That is the kind of detail that matters in private credit. A fund can report attractive income. A loan can appear performing. But underneath, a borrower may be struggling to breathe. This is the part of finance that most people never see. It is not dramatic like a bank run. It is not visible like a stock market crash. It is slow. It is contractual. It is hidden in loan documents, valuation marks, refinancing calendars, and private negotiations. And that is what makes it powerful. Private credit is not just lending money. It is a machine that turns illiquid loans into investment products. It takes debt from companies that public markets may not want. It packages that debt into funds. It sells those funds to investors searching for yield, and it earns fees along the way. For asset managers, this is a beautiful business. They collect management fees. They can charge performance fees. They build long-term relationships with private equity sponsors. They grow assets under management. And because private credit is less transparent than public markets, the biggest players can claim they have special access, better underwriting, better data, and better control. Sometimes that is true. The best private credit managers really do have advantages. They can negotiate stronger protections. They can monitor borrowers closely. They can structure loans carefully. They can step in early when things go wrong. But the more money floods into the market, the harder it becomes to maintain discipline. When too much capital chases the same deals, lenders compete. When lenders compete, terms can weaken. Borrowers get more power. Spreads compress. Covenants become looser. Risk increases at the exact moment investors feel safest. This is one of the oldest stories in finance. A good idea becomes popular. Popularity attracts capital. Capital lowers standards. Lower standards create losses. And then everyone pretends the losses were unforeseeable. The private credit industry argues that the fears are exaggerated, and to be fair, it has a point. Many private credit loans are senior secured. Many funds are not using the same kind of short-term funding that made banks fragile in 2008. Many institutional investors understand the illiquidity, and some recent failures that were blamed on private credit may have involved fraud, poor corporate controls, or traditional lenders as much as private credit funds. So the honest answer is not that private credit is about to collapse tomorrow. The honest answer is that private credit has not yet been fully tested through a long, painful downturn at its current size. That is the key. A small private credit market can absorb mistakes. A $3 trillion private credit market becomes harder to ignore, especially when it connects to banks, insurers, pension funds, private equity, and retail investors. Especially when borrowers face higher interest rates. Especially when weaker companies need to refinance old debt. Especially when some investors believe they own something safer and more liquid than it really is. The danger in private credit is not that nobody will get paid. The danger is that people may not know what risk they actually own. A pension fund may think it owns stable income. An insurer may think it owns predictable cash flows. A retail investor may think a private credit fund is like a bond fund with better returns. A bank may think its exposure to non-bank lenders is well controlled. A regulator may think the risks are spread out. And all of them may be right in normal times. But financial crises do not happen in normal times. They happen when everyone tries to reprice risk at once. When borrowers cannot refinance. when investors want cash, when valuations are questioned, when lenders discover that senior secured does not always mean safe, when the machine that created stability also delays the recognition of losses. That is the paradox of private credit. It may make the financial system safer by moving risk away from banks, but it may also make the system harder to understand by moving risk into places where transparency is weaker. It may provide useful financing to companies that need it, but it may also keep over-leveraged companies alive longer than they should be. It may offer investors attractive returns, but those returns may be payment for risks they cannot easily see, sell, or measure. And that is why private credit matters. Not because it is evil, not because it is guaranteed to explode, but because it shows how finance evolves. After every crisis, regulators close the last door. Then capital looks for another one. After 2008, banks became safer, so lending moved outside banks. Private credit is the result. It is the shadow of the banking system, built by some of the most powerful asset managers in the world, funded by institutions that manage society's retirement money, and increasingly sold to investors who may not understand the trade-off. The machine works as long as borrowers pay, investors stay calm, and valuations remain believable. But if one of those breaks, the world may finally discover what was inside the $3 trillion debt machine. And by then, it may be too late to pretend nobody saw it coming.